Hi everyone, I'm Laurel Marie Hickey. Welcome to What's Blank Got to Do With It. Our What's Blank topic today, the Magnificent Seven. So what's the Magnificent Seven got to do with it? The Magnificent Seven are 7 companies in 2023 that had phenomenal performance. They are Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. These 7 companies dominated in performance in 2023 in the US market. They benefited from the artificial intelligence frenzy that we had in 2023. As well, they have strong brand recognition and customer loyalty. They are so large that Microsoft, as an example, at this time is worth over $3 trillion. The Magnificent Seven, yes, they are magnificent, but they may face some risks going forward. They may not always move in the same direction that they had in 2023. Their earnings and growth prospects may vary. As magnificent as they are, they were not the only drivers of performance in the US market. There were other sectors that did very well in 2023. The US equity market reached historical highs in 2023, and the year did not start out that way. In fact, we had kind of choppy. We had the first couple of good months, and then it was choppy throughout the rest of the year, and we saw towards the end of the year just a real burst of growth in many of these stocks and overall market. So this is an example of really staying true to your investment strategy. Ensure that you're paired with an investment strategy that matches your risk tolerance, and always invest in a way that you're aligned with. If you have exited the market early in the year and then re-entered later on, it's hard to say if you would have the same type of performance. So it's always important just to stick with your investment strategy, but also to have conversations with your trusted wealth advisor if your risk tolerance is shifting. Your trusted advisor will always want to know how you're thinking and feeling. Yes, the Magnificent Seven are technology-based companies, so to have an entire portfolio of 100% technology has a lot of risks attached to it. It is important to have a diversified portfolio with many sectors. You can have a component of technology in your portfolio, a component of pharmaceuticals, a component of consumer discretionary, and so on, financials, energy, whatever it might be. You want to have exposure to various opportunities in a broad range of sectors. One of the common factors that analysts and investors look at when evaluating the performance of the Magnificent Seven is their ability to consecutively beat earnings and expectations. So as long as they are beating earnings and beating expectations, that's a good thing, then they typically will perform well. This means that they are consistently reporting higher profits than the market anticipates. This often leads to a positive reaction in the stock price. The growth of these companies is impressive, but the question that we hear a lot is it sustainable? When a company is continually beating earnings and having higher growth estimates, investors start to expect more and more. When your expectations are high, even a slight deviation from this upward trajectory can cause volatility in the stock price. And this is something that we're hearing a lot from various market participants and analysts is, can it always stay this good? When we were talking about consecutively beating earnings, we were referring to earnings momentum. Analysts from multiple banks and investment firms that cover particular companies estimate a value that they expect the company's earnings to be each quarter and how this will translate to the stock price. When this continually happens from quarter to quarter, the momentum can be a good screener for companies that are on an upward trajectory. So people are always interested in this type of trajectory for them to be momentum-based companies. That said, earnings momentum doesn't necessarily translate to earnings quality. So this factor cannot be viewed in isolation. It's always important to consider the price that you are paying for the company, and if it makes sense relative to the earnings over the long run. In our models, we do screen for earnings momentum. We like that as a factor, but we pair this with other fundamental factors. As well, we pair it with technical analysis. So we like to look at things fundamentally, but we like to look at things at technically as well. So we really pair two different strategies for stock selection. We also like to look at debt levels, cash flow, and also returns adjusted for volatility, just to name a few. Overall, we feel that sticking to a holistic approach can help find quality companies that will hopefully have sustainable performance over the long term. I hope I've explained a little bit more about the Magnificent Seven of 2023 and the trajectory possibly going forward, as well as a few other important things to look at when you're choosing companies for your portfolio. It is very important to work with a trusted advisor that you're aligned with. Super important to invest in a way that matches your risk tolerance. In our industry, there are 5 different risk tolerances. Number 1, maximum growth; 2, growth; 3, balanced; 4, conservative; 5, income. Each of those risk tolerances has a component of equity in them. The maximum growth will have a lot more equity in it as opposed to the income portfolio, and the balanced is right in between in the middle. As always, please feel free to reach out to me if you have any questions or if I can help in any way. My name is Laurel Marie Hickey with 3i Global Wealth of National Bank Financial.